While sports or weather news pieces may be easily understood, stock market news can sometimes feel like a secret code. It's true that some people are extremely wealthy, but how? You're not the only one who finds the stock market confusing. It's not your fault that these things aren't taught in schools, but on the plus side, you can pick up on the fundamentals very quickly. Exactly what is stock? Imagine taking a business and dismantling it into several small parts. One of those little parts, or a stake in a company, is called a stock. We mean it when we say a lot of tiny pieces. For example, Amazon consists of more than 500 million shares. Purchasing a stock entails purchasing one or more of those business components. Generally speaking, you can only purchase stock in publicly traded companies. A public corporation is one whose stock is traded on a stock exchange, which is a public market. Not every big national company is publicly traded, even though many of them are. Less than 1% of the roughly 600,000 American businesses with at least 20 workers are publicly traded. Let's take the example of someone who loves candy and wants to buy a portion of a candy company to fulfill their Willy Wonka dreams. Too bad if you want to own stock in Mars, the firm that makes M&Ms, Snickers, and Skittles. Since it's a private corporation, shares aren't available for purchase. If not, you may have to make do with Hershey's, which is a publicly traded corporation, and hence lists its stock on the stock exchange. Having established our understanding of stocks, let us return to the news. The phrase "stock market went up" refers to an increase in the overall price of shares of publicly traded corporations. This does not imply that the value of each company's share increased. Rather, it indicates that, on the broader stock market, investors paid a premium for a company's shares today compared to yesterday. On the other hand, if you hear that the stock market declined, it indicates that traders are generally paying less for equities now than they were yesterday. What does it imply when you hear phrases like, "the Dow was up today" or "the S&P was down today"? In actuality, bundles of stocks known as the Dow and the S&P, or S&P 500, are thought to be indicative of the stock market overall. Imagine it as a platter of appetizers that includes a variety of items. The S&P 500 represents the shares of 500 different companies, whereas the Dow is a compilation of 30 different corporations. It is crucial to understand that the stock market is not a barometer for the state of the economy, despite the fact that people frequently use the Dow or the S&P 500 as stand-ins for how the stock market is performing. Since many of us confuse the economy with the stock market, this may seem contradictory, but the two are not the same. The system of the economy is vast and intricate. It's truly difficult to define because it's so vast and intricate. It includes a wide range of variables that are all interconnected and have an impact on one another, such as taxes, the cost of products and services, employment rates, and many more measures. Many individuals mistakenly believe that the stock market represents the entire economy, since it is easier to understand than the overall economy, despite the fact that the Dow fluctuates in value. Consider the economy as a whole as a football stadium. The scoreboard is analogous to the stock market. It provides you with a wealth of important details about what's happening inside the football stadium, such as the score, player statistics, and attendance figures. But you never imply that the entire field is the scoreboard. The stock market is just one aspect of the economy. There is a whole other one. The economy and the stock market can, in reality, occasionally become disjointed. For instance, the stock market is hitting all-time highs amid the 2020 coronavirus epidemic. On the other hand, millions of Americans are bracing for financial catastrophe. How is that possible? The reason is that stock owners are the only ones who directly profit from a thriving stock market. As reported by the New York Times, the wealthiest 10% of households in America control 84% of all stocks. That implies that the wealthiest gain the most when the stock market does well. Milton Friedman, one of the most significant economists of the 20th century, claimed that a CEO worked for the company's owners or shareholders. This implies that her sole duty is to maximize profit. Her role is to literally keep expenses down because profit is calculated as revenue less costs. Salaries and benefits for employees are a significant expense for many businesses. The financial situation of those workers would undoubtedly improve if a corporation announced raises for every employee. But it would increase the expense of conducting business. Therefore, a CEO would try to keep staff compensation low to perform her job and raise stock prices, according to Friedman. Therefore, it's not a guarantee that your financial situation is becoming better just because you work for a firm whose stock price is rising. So how can regular people like us purchase stock? And how can you ensure that you profit and avoid losing money? There is no shortage of businesses or applications that enable you to trade, buy, and sell stocks. Before choosing one, do your homework, because a lot of them could have costs that exceed any profits you want to make from trading. Trading stocks is quite simple once you set up a brokerage account, which is the name of your stock trading account. 3 stages can be used to simplify a stock trade. Purchase 1 or more shares at the price at which the market is transacting. Second, give it some time. Minutes, days, months, years, or even decades could pass. The stock price will fluctuate over this period for a variety of causes that people will never fully comprehend. Third, sell those shares for the amount that the market is willing to pay. And that's it. This is a basic approach for investing in the stock market. There are more complex ways as well. Purchase an item, hold on to it till the price drops, and then sell it. After making a purchase, you want the price to increase, but it might decrease. Ideally, you can follow the well-known maxim, buy low, sell high, in order to profit. You may be asking yourself, how can I tell if a stock's value is rising or falling? Regretfully, you don't. That's essentially what the stock market is all about. Purchasing a stock is effectively placing a wager that it will increase in value over time from the point of purchase. Prices may, however, decrease. This means that you may end up getting less money for your shares when you sell them. It's how financial loss occurs. It is quite silly to believe that you can time the stock market because, in general, nobody can predict the future. It's highly likely that someone you hear promoting flashy stock market secrets or no-lose trading tactics is lying to you in an attempt to upsell you. Invest in equities and hold them for a very long time, even if the market declines. In conclusion, even though the fundamentals of the stock market, buy, wait, sell, are simple to comprehend, it's crucial to conduct far more investigation than what this video offered before making any investments. Speak with certified financial planners, individuals you can rely on to look out for your financial interests rather than just their pocketbook. There's not a hurry. Neither the stock market nor the news segments covering it are going away. But perhaps you now have a better understanding of the significance of those tales.